Good afternoon, everybody. Welcome to the TraderMerlin Show. It is your Monday edition. Now, fingers crossed, as Margaret has them crossed as well, for good audio today. I spent the weekend just basically deconstructing the entire sound system over here and making sure it sounds absolutely fantastic. So hopefully, fingers crossed, it will sound great today. Our show is driven from listener questions. As you guys know, I told you last week I was going to have Justin Krebs on the program, and we were going to talk about longer term investing, maybe annuities, retirement products, and a great question came through, which I thought, you know what, let's address this one first and foremost to start the show. And I'll read the question to you, and then we'll bring on Justin. The question is pretty simple. This is from Gene. He says, could you ask Justin about taxation during retirement? I'm 64 and have a good amount of money saved. Just wondering how to minimize the tax hit when I withdraw. Now, of course, that is a pretty complicated question, and I thought let's talk about retirement taxation. Joining me today from the East Coast, we've got Mr. Justin Krebs joining us. Justin, welcome back to the show, my friend. How you been? Now that I've unmuted you, I'm doing great. And for the viewers out there, let me know if the audio sounds good or bad. Justin's the important one. I don't sound, my audio doesn't matter at all. But Justin's looking good on camera. I think he sounds good to me. So hopefully we'll roll through this without any problems today. Justin, what's new in your world? It's been, I think, like 6 or 7 months since I've had you on the show. I figure you must be doing something exciting over there.
I mean, I don't think I've had any more kids in the last 6 or 7 months. So. I don't know if I can afford any more. Yeah, with the 5 I've got right now. But no, I mean, first day of school for the kids right now, and just kind of rocking and rolling this year. So that's about it. So with the real estate prices, are you going to buy yourself a giant boot? Because I do think with that many kids, you should live in a shoe just to keep historical precedent there. Yeah, I mean, I was actually considering the boot, but they've been a little bit hard to come by lately here in my area. So yeah, it's with the prices. I think you are getting the boot on that one. Let's start with the question that came here from Gene. I know we can talk about all sorts of different things, but let's address that one first because I think it's a great one. You know, we are told by our financial advisors, by the institutions, by the media, by every publication, save for retirement, invest, 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 and of course we have a wide selection of different vehicles we can choose from, but ultimately, you know, you might get to retirement, have $1, $2, $3 million saved up. And you're like, great, this is all going to be fantastic. Now it's time to retire. And in Gene's situation, I don't know how much money he has, but, you know, going to retirement, well, what can I do to minimize that hit? Because if I take it all at once, it's going to be at the highest tax bracket. And what things can we do to help take a little bit away from Uncle Sam within all legal reasons, of course? No, I mean, it's actually a great question. And it's a question that I think, you know, I deal with as a financial advisor. I actually deal with this in almost every client that I actually work with. You know, for me, when you take a look at actual retirement, to me, there's 5 pillars underneath your retirement house. One is income. You got to have income. There's literally no retirement without an income. Mm-hmm. So understanding things like Social Security and having good sources of income that are not market dependent. That's the problem that a lot of folks get into. Somewhere along the line, Wall Street's kind of convinced everybody that you should sell your Microsoft stock to pay for your groceries. That's not really the best idea. But so you make sure you establish your income. Obviously, your investments, you know, are going to shift. You know, the last 30 years, you could obviously be a bit more aggressive than the next 30 years coming up. So you've got your income, your investments. You obviously have to pay attention to healthcare, Medicare, all that kind of stuff that you've got, you know, even long-term care for a lot of folks. Obviously, estate and what you leave behind is going to be important. But probably the second biggest item that I deal with is taxes. And you're right. We're just kind of conditioned to just save, and think about taxes from a micro standpoint. In other words, we save money now. Well, the problem with that idea is it feels good. It sounds good when you can get a deduction on your taxes or even get a refund, you know, the year. But think about most people, like in Gene's case, he probably spent the last 20, 30 years. He had deductions. He had, you know, mortgage, you know, he had mortgage interest, you know, deductions. He had child care deductions. He had, you know, he was probably contributing to a 401k, which lowers his tax, you know, taxable income as well. But the problem with all that is that once he saves, and maybe he gets a couple million in the bank, but it's all under tax deferred situations. So we put that money away in tax deferred situations. Now, tax deferred doesn't mean they're going to get rid of the taxes. It just means the IRS is going to come get it later on in life. And later on in life, what do you have? When you retire, you have no deductions. The kids moved out, the mortgage is probably paid off by now. You're not contributing to a 401k anymore. And now all that money you've got in that 401k is now got to come out. And whether you need it or not, it's going to come out. The IRS is going to make sure at age 72, they're going to start making you take that. So somebody like Gene, let's say Gene has a couple million in a 401k. Let's not even talk about his income right now. But regardless of what he needs, the IRS is going to start basically in 72, is going to make him take out about 4%, starting with 4% each year at 72. So if you got $2 million in a 401k, that's $80,000 of fully taxable money that's going to hit you.
Mm-hmm.
Right?
And there's no special taxation on it. This is just standard income.
That's just standard income. And there's nothing you can do about it, right? I mean, absolutely nothing. And that goes up. That required minimum distribution goes up. And I've worked with folks that, they'll have like 1.5 million, 2 million in the bank. And by age 86, 87, they're having to pull $150,000, $160,000 from their 401k, from their IRA. I mean, people don't understand that what that does to your tax bracket, your effective tax rate, when you've got to, pull that money, whether you need it or not.
Right.
And that's a big tax hit. And we're not even talking about whether or not taxes actually go up in the future, which, we can get into that discussion. But people don't quite realize that consequence. And let's say Gene's married, so let's say Gene's married and let's say he dies. Well, the problem is that another problem people don't think about on the taxation side, he dies, all the money passes to his wife. Mm-hmm. And guess what? The wife is now filing. The wife is now filing. She gets all that money, still has to take the required minimum distributions. And now she's filing single, which pushes her tax bracket even higher. So there's all kinds of these nasty little tax consequences that people don't really consider when they start saving. They certainly not when they start saving for money, or saving for retirement. Once they get into it, that's when the time when they start to go, oh, what can I do to minimize my taxes?
Right. I think that the cool part about it is for most people, you're going, okay, I've basically had this wonderful thing I can invest in, and it's taken a little bit of it may have even reduced my tax exposure a little bit. I'm paying, obviously, not paying taxes up front on it. I'm going to pay taxes when I withdraw. Now, of course, there's different vehicles. Of course, in Gene's situation, nearing retirement, maybe at retirement, he's already locked in. But, for somebody who's starting off, like somebody's in their 20s or 30s, I'm not a financial advisor, but all of my studies and spreadsheets, like, do a Roth, right? If you can do a Roth, do it as soon as you can, because obviously if you can grow your income using smart investments, whatever strategy you're using, and grow that faster than the typical rate, which is 8%, then you're at the end going to have so much more money, and you can pull all that out at once without any tax consequences if it's in a Roth IRA, right?
Yeah, so there's a couple layers to what you just mentioned there. So first of all, let's take somebody saving for retirement. Whether or not you like it or not, you're going to pay the taxes at some point. So for me, my company's called the proactive investor, because for me, it's about being proactive on things. And I always tell people this: if you're saving for retirement right now, you know what the tax rate is now. If you save under a Roth IRA or a Roth 401k, you know what you're going to be paying. You can do the math and you can know what the taxes are now. You have no idea what they're going to be 5 years from now, 10 years from now, 20 years from now, right? You have no idea what that's going to be. And because the growth rates and everything like that go into it. So the question you have to ask yourself is this: if you're in your 30s, your 40s, even in the early 50s, if you're saving that money in tax deferred vehicles, ask yourself this question: are taxes going to be higher in the next 10 years or the next 20 years than they are today? Right. And I think it's pretty apparent that taxes, if you're under the same opinion of mine, we have we have so much debt in our country. We actually have the highest debt to GDP ratio in history. And here's just a factual statement: every single time we've gone that deep into debt, we've taxed our way out of it. whether you're talking about World War I, World War II, the Great Depression, every time we've done that, we've taxed our way out of it, right? So and in fact, we have a guarantee that taxes are going to go up because it's already written in the law that the 2017 tax cuts are going to expire in 2025. They're going to sunset. So you're going to find yourself in a higher tax bracket, even if you don't change a thing. So somebody who's in their 30s, let's say they're working for a big company, it makes sense. It makes sense for them to save in a Roth IRA, or for their company, maybe they have a 401k. Here's a little known fact: about 90% of large employers, which is defined as an employer that hires 500 or more people, they have a Roth 401k version to that. So you can switch in most large companies, you can switch from the from the 401k to the Roth 401k version. And yeah, you're right. You put money away there. There's no real tax benefit now, but all that money is going to grow tax-free for the rest of your life. And any money inside of a Roth situation is not required to be distributed to you. The IRS cannot make you distribute that money when you turn 72, when you get into the retirement.
Right. Good comment here from Big Gab. He says, Roth IRAs are limited to income levels. Yes, there are certain caps on those investment vehicles, but yes.
And that's a really good comment. And this is, again, one of the most understood elements. Everybody can save in a Roth IRA. There's 3 ways to do it. One, you're right. You can just make a regular contribution. So if you're under 50, you can make a $6,000 contribution to a Roth, but that is capped. It is capped by your income. It's somewhere north of about 120. You start to get in that range, you're not able to contribute to the Roth. However, that's just one way. For the high earners out there, you still can contribute to a Roth. It's called a backdoor Roth. So I know the name's a bit funny, but the backdoor Roth is for the high earners. So the high earners, what they can do is they can contribute to a regular IRA. Now, since their income level is so high, that contribution will be a non-deductible contribution, but they can still make that $6,000 contribution. However, all you have to do is, so this is what I do with some of my high earner clients. We put it into a regular IRA, we sit it there for one day, and then we roll it over into a Roth. That's called the backdoor Roth. Simple, you can do it. There's legislation to try to get rid of it. There's even something called a mega backdoor Roth, which is a 401k version of it, which is even more powerful. You can save even more than $6,000. But it's a way to get money for those of you who are high earners. Yeah, you can get the money into the Roth IRA. Mm-hmm. Now, really important is once you turn 59 and a half, it's all go now, because now you can convert all tax deferred money into the Roth IRAs, all kinds of, on the tax-free bucket side of things. You can make those conversions. Sure, you have to pay the taxes now, but again, most likely taxes are going to be higher in the future. And if you really look at your entire lifespan, you're going to be paying a lot more in taxes than any individual year that you would do a conversion anyway. Mm-hmm.
Real quick for the viewers out at home, I'll show you this because I think it's a good conversation piece, which is what's going to happen to taxes in the future. I have the top federal tax rates for the United States going back to 1913. Wouldn't it be nice to be back in 1913? We were paying about 8% federal income tax for the high bracket. Gone are those
highest bracket.
Those the highest bracket. Gone are those days. But then of course you got the 1940s and 50s when you're up around 90%. Now of course I don't think we'll get to 90%, but I really think that if you look at the trends, and really since 1988, you can see it's been stair-stepping up from, let's call it 1988, you were looking right around 28% was your highest tax bracket. Now it's about 40.8 according to most recent data. And, with as much debt as we have and the issues that our government has and all this more and more spending, the probability is higher. We're going to see higher tax rates going forward. So, taking into consideration what Justin was just saying, it may be prudent to switch over, if you can, into something that doesn't tax you when you take out of your IRA. So the Roth component being great, whether that's a backdoor IRA or just, he's mentioned, waiting till you can finally take out those withdrawals and roll it over. Either of those might be a great choice for you because, as you mentioned, if you pull all that out in a regular IRA, you're at the maximum tax bracket. And I got a ton of questions coming through here. Let me see if I can read through some of these. Can you put your 401k investment money in an irrevocable trust fund?
Can you put it into an irrevocable trust? Yeah, I mean, you can put it into an irrevocable trust.
It doesn't save you taxes, though.
Yeah, I'm not sure why. Yeah, I'm not sure why you would do that. There's no real tax benefit to that. You'd take the tax hit on the 401k and roll it into a taxable account that's going to be taxed every single year inside of a trust.
I think the main benefit with that one is with an irrevocable trust, you're basically shielding it. So if you are in someone who's got litigation or maybe I'm not going to say going through a divorce because you'd already be, unless that's already separated up front. That's really to shield assets, not necessarily taxation. What's nice about irrevocable trust and things like that is the passing on to survivors. So you don't, like the will aspect and the living trust is a great component because you don't have to go through all the probate pieces, which can add on a ton.
Now, one thought of that, Merlin, is that there is a way to get tax-free money out of that, and that would be if you convert it into inside of that irrevocable trust. There are certain types of investment type life insurance. Some people call it LIRPs. Long-term, not long-term, life insurance, retirement plans.
Right.
Things like Index Universal Life. Those are all tax-free vehicles that you can put money into. They grow really well. They're protected and shielded from the market. You can put those into trusts, and if you die, you got life insurance really, and it passes to your kids. But if you don't die, you can actually then use that money inside of that LIRP or that IUL to actually pull for tax-free income down the road as well.
That's an important one. I think a lot of people, when you hear the term life insurance, whatever variety it is, because there's so many different types, we think, oh, I buy this, and if I die, then the money goes to somebody. But a lot of people will use specific life insurance products and accrue that cash and pull that out during their lifetime. So it's an investment vehicle that they're using with life insurance products. I thought it was kind of an interesting twist because we're led to believe it's just for life insurance, and it's not.
It's not. No, I mean, and that's the thing. It's like saying a phone. There's all kinds of different phones. There's rotary phones or cell phones. There's all, we use these modern cell phones for a lot more than just making phone calls. Well, that's what certain types of life insurance actually are. And they're not heavily advertised because guess what? When you mention the word life insurance, what do people think of? Term. It's crap. You invest, you put your money in and it's an expense and you lose it after, if you live, you're fine. There are certain types of in life, actually investments that are life insurance that are far more conducive to I actually use those type of life insurance as an actual investment asset, as a portfolio asset. After though, people have maxed out some of their other assets like market assets or income assets, stuff of that nature. So
one more question, and then I'll go to back to Gene's comment or question to start. There's people asking about specific timeframes for the Roth. So if you roll into the Roth, is there a specific holding period that you have to hold that before you can start pulling out of a Roth?
I mean, that's another great question. So the only disadvantage, really the only disadvantage for doing a conversion is that people perceive that you're going to be boosted into a higher tax bracket, which you are, right? If you do a massive conversion all at once, you will be boosted into a higher tax bracket. But you're taking, basically, if you just do it 1 year, you're taking that one-time hit, and then the money is then free to grow, and you never have to pay taxes on money again, which statistically, and I've run it's got to be 1,000 different analyses on this. And almost in every single case, unless you qualify under a special situation, it is worth to get rid of all that taxation up front, because especially if you live anywhere into your late 80s or early 90s. If you're anticipating that you're going to live somewhere in that. Now, if you're planning on dying early, don't do that.
Let's not plan on dying early, anybody.
So obviously, right? But if you really take a look at the idea of I structure it depends on everybody's situation, obviously. Their income levels, their longevity, all that kind of stuff. But I'll structure some where we'll do it all at once. They'll take the tax hit and then boom, they're tax free. And the numbers work out on that as well, unless taxes go down.
Right.
which is not likely to be the case, right? And people just think in terms of each year. You got to think in terms of every year that you're in retirement, that taxation. And that's much greater because think about that longevity. Your money's growing. It's going to be taxed it's going to be taxed on not just what you put in, but the growth of it as well. So people just think, oh, I'm going to be in the 37% tax bracket. Who cares? If you get rid of, that's not your effective tax rate. That's just the bracket. You get rid of that taxation now and you avoid having the 22, 24, 28% tax brackets down the road, you're winning on that situation unless taxes go down. But for a lot of folks, they don't feel comfortable with that situation. We try to structure mostly anywhere from a 4 to 7 year tax plan. So we'll just basically take chunks of money and spread it out over 4 to 7 years, depending on their comfort level. And it depends on the aggressive mindset of the individual as well. Some people, they want to get as much as they can or all of it into tax-free situations. Other folks, they just want more of a balance because I'll throw out a number for you, Merlin. If you can get your tax deferred assets somewhere in the neighborhood of about $780,000, then your required minimum distributions will pretty much stay under your standard deduction for most of your life. So in other words, your required minimum distributions won't really hurt you if you can get the tax deferred assets down below there.
Right.
I mean, there'll still be a pain,
sure,
but but that's kind of what we work towards because everybody's different. So like Gene's question is a great question, but it would start with one. What's his overall objective? Because if his overall objective is I want to maximize how much money I leave to my kids and my grandkids, well then being more aggressive on the conversions to tax-free buckets easily. I mean, absolutely easily. I just worked on a case just the other day where the gentleman had just about $1.1 million. And we worked on a 4-year conversion plan on his. And the difference between what he would leave, and again, same investments, same growth rate, everything. All we're doing is taking money from the IRA and putting it into a Roth. That's the only difference. One tax bucket to a different tax bucket. He was going to leave his kids $800,000 more net. $800,000 more net just by doing it that way.
Wow.
That's a substantial amount of money. So if the goal is I want to leave the money to the kids or the grandkids and I want to maximize that, it makes sense to be more aggressive on that situation.
Right.
However, if it's just about just saving as much taxes that you want to or can, and you still need to pull a pretty decent amount of income to support your lifestyle, well, then being less aggressive on that Roth conversion is probably the way to go because you're going to have to pay taxes on pulling the money out anyway. So, again, it depends on everybody's circumstances and what their actual goal is.
Well, it's all about planning. I mean, ultimately, everybody's going to have different objectives, different goals, different needs and wants. And it's funny because for me, right around my mid-30s, I just said, okay, I'm no longer looking to amass a specific amount of money when I retire. I'm working towards setting up specific income streams so when I do retire, I can continue to have the lifestyle that I want based off that income stream. And I think most people don't think that way. You look at these like E.F. Hutton commercials, and I remember I think Ameritrade had one where there was like a green line that people followed to achieve their goals. And most of those goals are just, here's how much money you should have. And in Gene's case, I'm assuming he's in a traditional IRA or a traditional 401k. Yeah, there might be some substantial hits in that one. And, Tom mentioned a good point. He says, when people retire, they're at their lowest tax bracket anyway. Not necessarily. I mean, normally they're not working as much, so they certainly are making less income. However, when they start taking these distributions, you will be required to take specific amounts, and that could start to pop those levels up. And I think that's where Justin's going with this, is saying, if you know those levels are going to jump into, say, the second or third tax bracket, could we do something that I'll pay some taxes now and then drop me for the remainder of my life in a non-tax situation, which of course over the long haul should benefit you if you're going to be living a long time.
That's an interesting comment by Tom, because I don't find that to be true amongst most of the people that I work with. In fact, if I go back into my numbers, it's probably less than 5 to 7% of folks that will find themselves in a lower tax bracket. And here's why. The only reason you find yourself in a lower tax bracket is if, one, you were a very poor saver, right? So in other words, you didn't save all that well, but in the last few years of your working, you amassed a pretty good income, right? And I've got a good example of a guy that, another client of mine, same thing, him and his wife, they worked all their lives, but they were just job to job, and they had kids problems and stuff of that nature. So they never really put a lot of money away. But 5 years ago, he got a job with a friend of his who was starting up a company, and that company exploded. So he went from not really making a whole lot of money his entire career in his life to making like almost $300,000 every single year. And yeah, his tax bracket's really high, and he will never get, but he only has like $300,000 actually saved in tax deferred money. So for him, there was no tax plan, because you're right. He retires, he's going to find himself in a lower tax bracket. But for 95% of the folks that I work with, when they retire, that doesn't mean they stop spending. You will have about the same expenses, especially if you're thinking about maintaining your lifestyle over the next 5 to 10 years. That first 5 to 10 years, retirees are busy crazy. It's ridiculous. They retire, but then they like do everything that they possibly can for the next 5 to 10 years. But then what happens is that 5 to 10 years down the road, then you get hit with those required minimum distributions, which maintains your tax bracket or increases it depending on your circumstance. So it's rare to find somebody who just, has a decent income, has decent money saved, and they just retire and they find themselves in low tax bracket. That's usually not what I find, but it's possible. That's why everybody's different there.
Yep. Good question from NJ. He says, what's the best thing to do at retirement age when you want to use your retirement? Withdraw monthly or all at once? And loaded question. I guess number one for me depends on what type of retirement vehicle you have to make that statement. But I'm pretty sure, let's just say it's a traditional 401k, IRA, no Roth component, but just a standard IRA. What would you say?
Honestly, income when you get to retirement is an expense. I know that sounds weird to say, but income is an expense. So in that regard, it makes sense to do it monthly. And most of the clients that I have, we structure automatic distributions every month, like the first of the month, or whatever they want it. Just because the more money that's in the account to grow, the better off that you're going to be largely. Now there's tax consequences, which, we were talking about on the tax on the tax bucket, but yeah, it makes sense most of the time to do kind of monthly distributions.
Yeah, and as Big Eb says, you're going to get hit all at once. So if you pull it all at once, you're going to take a massive tax hit. You'll be at the highest tax bracket. So probably not the smartest thing to do. I know what you're probably thinking. You're probably in your mind thinking it's kind of like the lotto winnings, right? Well, if I take it all now, I'll probably earn more over my lifetime because my investments are going to be better. Well, if you are in an IRA or a 401k program, you actually can do a lot of the similar things that you would do if you're self-directed, right? You would have mutual funds generally to choose from, but maybe it's self-directed. You can start to allocate your investments in the best way that you see fit. However, I don't think that pulling it all out at once, especially if it's a traditional IRA, would be the right way to go. You just pay too much. And this is where the planning comes in. You got to say, okay, if I pull this much out each year, what tax bracket am I going to go up to? And you go right up to that next one, and just say, okay, I'm going right to that edge there and optimizing things. There's also some vehicles that you can use. I know we've talked loosely about annuities in the past. There are some annuities you could be using here that would help lessen that tax burden during retirement as well, right?
Annuities annuities are just an investment vehicle that takes on the tax attributes of whatever money that was put into them. So if you put IRA money into an annuity, it's taxed just like an IRA. If you put taxable money, or non-qualified money into an annuity, it's taxed just like taxable money, right? You pay the taxes on it when but you pay it only on the capital gains. Roth, you can set up an annuity that's a Roth as well. Mm-hmm. So, but that's also tax-free as well. So it just depends. And yes, again, this is where, when I look at somebody's overall situation, I look at not just their investments, but I look at their tax buckets. So if I have somebody that has a very large amount, which is rare, in non-qualified taxable money, right? Because the actual statistics are this: 91% of Americans, retirees, right? 91% of their money is sitting in tax deferred vehicles. 8% sitting in non-qualified funds, and 1% or less than 1% sitting in Roths or tax-free vehicles.
Oh, less than 1%?
Less than 1% of
Wow.
Americans. Yeah.
I was shocked.
Yes, I was shocked too, but it holds true with most of the people that I work with. But there was one fellow that he had probably a good 70% of his money in non-qualified funds. For him, an annuity was perfect for that because, one, he didn't want to take the risk of the market. He wanted to have that safety, but the annuity actually defers the capital gains on that, right? So he's not taxed every year on that money. Just when he takes it out, a small portion of that's going to be taxed as capital gains, which counts towards your income.
Which is generally going to be less than standard income tax.
Right. So I mean, that made sense as far as from an investment standpoint, due to his tax bucket. So because that's really what's important is that, I mean, the first thing when you're working with anybody or planning your retirement is that you want to make sure that you have your income streams, and you want to make sure you properly weight your income and Social Security, which is important. There's 3,000 different filing rules. There's hundreds of different combinations for a couple that's in their 60s over 62. So making that Social Security decision, it's not always taking it early. A lot of the time it's properly waiting until it's the right time to actually take it. And you need somebody that knows Social Security to do that. But properly weighting your income, right, in Social Security, and making sure that you have what you want for, at the bare minimum, the next 10 to 15 years, market independent. We're not going to worry about what the market does for the next 10 to 15 years.
Mm-hmm.
Okay. Now, the remaining money, then you have an investment plan. That's your growth bucket. So with that money, now you pay attention to the taxes and what the taxes are going to bring to the table, because there's nothing you're going to be able to do about the income. You've got to take that income, right? Unless you just do a mass conversion right now, you're gonna get hit with some of the taxes on it. But you take your investments, you structure your investments, and then that's where you kind of look for your tax buckets and what you're working with on the tax bucket side of things.
It's kind of an interesting question. Joe says, who should someone in their mid 40s talk to get a good plan in place? And he says CPA, and my gut feeling would say no, not a CPA. A CPA is like, okay, here's your straight taxes, but I think that there's it's two things really. It's saying I want to understand all my tax liability, all my approach to taxation with the vehicles that I'm in, but also what is the investment plan and strategy going forward to set up those income streams. So I would say definitely someone who's got a financial background, not just a CPA.
No, yeah, I mean you're right, and the answer is actually both. So here's the deal. Like, whenever I call myself a financial advisor, I'm actually a financial advisor. People use that term advisor to describe, and let me give you an example. Like not picking on Fidelity, but I actually like Fidelity. Fidelity, people there will call themselves advisors. They're actually not advisors. They're not they don't have fiduciary responsibilities. All they know is investments, not and only market investments. They know securities. That's it. Okay. An advisor like me, I understand taxes. I understand income and alternative type investments. I understand, obviously, securities, insurance, and all that kind of stuff, and even some estate stuff. So you need to find somebody that is a true fiduciary, that has a fiduciary responsibility as an advisor, and they will work with your CPA to make sure that you've got the best of, here's what we need to pay attention to tax-wise now, but here's what we need to think about over the next 20 to 30 years. Because again, I've said this already, the next 20 to 30 years, you're going to pay a lot more in taxes than just each individual year. Don't take a micro approach to a macro problem. That's what CPAs do. Not busting on CPAs. They're very good at what they do, but they're focused on saving you money now, not 20 years from now, not overall in your life.
Yeah. I definitely would err on the side of a financial advisor, somebody, a financial planner, someone who's mapping out the roadmap. And, like my tax guy, he's great. He's actually really good. And I know all my tax exposure. I know how this will impact this and this will impact that based off these tax brackets. But, I could ask him things about the markets down the road, and he's like, and that's not me. He just doesn't get that, which is fine. So I take what I learned there, and I just map out all my investment accounts and try to get those, like I say, those income streams that I need to achieve my goals. It's a tricky challenge. I think when we did the strategic investor years ago, or the long-term investment class, one of the first questions we asked people is, what number do you need? What rate of return do you need per year to live the lifestyle that you want? And nobody knows that. I was shocked to see how very few people go, oh yeah, I need to get 6.5% rate of return. Well, a lot of people going, I don't know, I just need to get as much money as possible. So planning, I think, is an important one. Certainly having someone like Justin help you out. Margaret wants to know, are you a financial planner, and what are your degrees? Ooh.
What are my degrees?
What are your degrees? He's got a degree in fatherhood. That's some financial planning right there.
Well, my degrees have really nothing to do with my actual career now. But I have a business degree, I have a master's, all that kind of stuff. But I have the licensing. So like as a fiduciary, I have to go out and I have to pass the Series 63, 65 exams. I have to be certified and pass the insurance exams and have licenses in insurance. And then you got other minor little things that you have to be certified in as well, and constantly keep up. Really your continuing education every single year to be able to do that. And I want to express how important that question actually is, because if you have an advisor at some big box firm like Merrill, or again, not picking on these guys, not saying anything bad about them, like the Fidelities, the Merrills, the Edward Joneses, all those big box firms, you do not have a fiduciary. They are not fiduciaries. That's not what they do. They can tell you all that you want to know about mutual funds and stocks, and they can advise you on that. They cannot advise you on anything else, nor do they look at how your securities interact with other parts of your plan. Because I'm telling you right now, your income affects your investments affects your taxes affects your income, your everything affects your estate, your health, all that kind of stuff. These are all the little inner workings that you have to understand in the retirement spectrum over the next 30 years. It's very unique than just saving for retirement.
Yeah, I agree. What else? There's a few other ones that came popping through at the end. It's funny, when I got my degree, so I have a finance degree as well, and it's funny, people ask me, like, do I think that my finance degree helped me in my trading? And I said, no. I think it showed me how the markets, it showed me how the markets are supposed to work, and then once I actually got into the markets, this is how things really work. And it was so different than my finance degree. I was just kind of blown away, and I actually went, I called my alma mater. I was like, listen, I'd love to come back and give you a speech on how financial markets really work, a presentation. They're like, no, we're okay. I was like, okay. You just keep teaching these kids stuff that doesn't really matter at all. I heard a couple comments about Social Security. I'm curious on your approach to Social Security. I have, ever since I was a young kid, always told myself, Social Security will not be there for me. And I'm built my entire plan out assuming zero from Social Security. Am I making a mistake from a tax liability perspective? Because, I could be making a few $1,000s extra per year.
Wow. We could spend a whole nother show on this.
Maybe we save that one.
Yeah, and I'm not kidding. So I actually am certified in Social Security, which is really odd and weird, and totally, most people are like, that's just a geeky waste of time right there. But it was actually worth my time, because what people don't understand about Social Security is it's guaranteed by the government. It's for life. It has a survivorship option to it. It adjusts for inflation. And it's one of the most efficient tax investments that you have, believe it or not. So here's the deal. Will it be there? Of course it will be there. And here's how I know. Throughout history, Social Security has run into issues. And every time it has run into issues, they've had to modify Social Security. Ergo, for example, the retirement age, or the full retirement age for Social Security when you can collect, has shifted throughout the years. So here's what Social Security is saying. If they do not make any changes by, I think it's 2033, it keeps changing, by the way, that the money that you're promised you're only going to get about 74% of it. And so it's going to be there, but if they don't make any changes, you'll get about 74% of what they had promised you, right? But here's the thing: they will make changes. They're going to. They have in the past. They will in the future. So for me and you, we have to worry maybe about this, but they might change the minimum age to 65, 66, or the full retirement age. Maybe they push it to 70, or maybe they tax Social Security more heavily, or maybe they just have more taxes or medic. You know what I mean? They'll find a way to, because you can't pull the rug. I mean, we joked about 2008, too big to fail, right?
Yeah.
Social Security is truly a program that's too big. If you pulled the main stream of income from 70 million baby boomers who depend on it, you're in big trouble in that situation, right?
Yeah, you lose votes. Well, here's the reason I say it is because last time I looked, Social Security and Medicare were like something like $160 trillion of unfunded liabilities.
Yeah.
And I'm like, we already have a government that's kind of on, shaky ground with regards to debt, and that debt is surging because of this money printing. Like, I agree with you. It would be the ultimate rug pull. But, when Social Security was set up, it was expecting that people, like, you live to, like, 68, 69. And now 80 is the norm. Now you're seeing 90s and 100s, and it's funding way longer than it's supposed to be. It's like either there has to be some major overhaul, or that Ponzi scheme's going to collapse, in my opinion.
Yeah. I mean, what they really ran into is that more people are collecting than people are working, basically. So, and that's not getting any better. So, they obviously will have to make some changes, but it's going to be unpopular changes, I'm sure. But back to your specific question, in most cases, what I've found is that, again, it depends on your circumstance, it depends on your taxation, all that stuff. But even if you retire, say at 66, delaying taking Social Security and actually self-funding, some of your retirement for a few years pays off about 75, 76% of the time. You actually have much greater assets, because if you think about this, every year that you wait in Social Security, they guarantee you another 8% on the money that. So if you do the math from 62 to 70, that is what is that? A 67? If I'm doing the math, that's a 67, 68 something percent increase in the guaranteed amount that they're going to give you. So I always put it to people this way: if you took all the money that Social Security was going to give you and you just invested it when you were 62, I'm just going to invest it in the market just to match the guarantee that Social Security is going to bring you for the rest of your life starting at 70. I think you would have to average something like 18% in the markets just to match the guarantee. It's not even reasonable to do that, because people think about that all the time. I'm just going to take it at 62. I'm going to just invest and I'm going to be just fine. No, you're not. You're not going to come anywhere close, right? So that could be literally a whole other show. Whole other subject that we could talk about there.
Yeah. Well, the good thing about it is that there's so many different sides to it, and I love what you've done, because you were this really active trader. Now you're like, I'm going to do something that at least I think is somewhat altruistic, which is helping people figure all this stuff out, because it's complex. I worked for a financial planning firm for a while, and the people that I worked for, at least most of the employees were good, but the leadership was just absolute greed. And it was if I showed you the list of investments that they were putting clients in, you just shake your head and you got to be like, we're talking front end loads of 5% on mutual funds, because the firm would get the kickbacks. They would get like 4% of that. And it's just like, come on, man, you got to do what's right for the customer here. And a happy customer that achieves their goals obviously is going to be the best thing for you going forward. So I decided to just do my own money and never manage anybody else's. So I commend you for taking that one on.
Well, that kind of reminds me of, I think it was Margaret's earlier question. You should find somebody that's independent. In other words, they have their own firm, or they work independent of these big box firms, because in order to do that, you have to be a fiduciary, right? So somebody that's independent has a lot more. I don't care what we get into. You know what I mean? I don't care what the client comes to me and says, hey, I want to do this. Okay, let's do it. Yep. We can choose any company that we want to do it with too. So that is important.
Yep,
if you want the right mix of things.
There was one more question and Big Eb, you're absolutely right. He says if you're still earning an income, you definitely want to wait. You most likely want to wait so you don't get taxed on the Social Security, right? Because it's going to count as ordinary income at that point. So
you should wait. You should wait. You won't see the Social Security before your full retirement age. There's literally the Social Security Administration will literally dock your Social Security if you have earned income over something like $19,000. They will dock $1 for every $2 that you make.
Crazy.
So you won't even see the paycheck.
Yeah.
You won't even see the Social Security check. So it's pointless to if you're still working to collect Social Security.
Nice. All right, last one here, and then we'll wrap up. Do you advise on health insurance? That's an interesting question here. Obviously, as you're getting older, I think the need for health insurance becomes greater and greater. What's your take on that?
Yeah, I do. It's part of my practice. I have a whole team that's set up for the transition between your retirement and when you can collect Medicare. And then I have a whole separate team that takes care of all the Medicare, questions and stuff of that nature. So because it is important. If you think about the average couple, it's going to pay $350. That's the average amount that they're going to pay out of pocket medical expenses over their retirement.
Yeah.
It's an important subject, certainly.
Yeah, no, I think last time I looked, it was like $200,000 for an individual person. And if you don't have insurance, man, that can wipe out a lot of that savings that you've built up real quick. Tell me a little bit about how people can get in touch with you. I have your website up here. I assume that's probably the easiest way. And obviously Justin's talked about a lot of different topics here, but if you'd like to know more, I'm assuming theproactiveinvestor.com is a place to go. Yeah,
you can go there. I'm still modifying the website, but it's starting to get more robust. I like it. So, people can contact me through the website. Obviously they can just send an email to theproactiveinvestor@gmail.com is kind of the general inbox one. And obviously a lot of your viewers even have my cell phone, so they can even call me if they want. So
I won't post that in the chat though. I'll just
yeah. So, I've learned the hard way. So
yeah, it's funny. I was in a Forex class once, and this guy was like, "Hey, can I get your phone number?" I'm like, "Okay, sure." And next thing you know, I'm getting calls at 2, 3 in the morning. Hey, what about the euro dollar? I'm like, dude, I'm sleeping. Leave me alone. Yeah. Cell phone numbers are rare to give out. All right. Hey, well, thank you very much, Justin. I appreciate you taking the time to come on the program. Next time, who knows? Maybe we'll dive deeper into some of these topics. But I want to thank Gene for asking that question to kick things off, and you gave us a ton of information here, and I'm sure a lot for people to think about. So thank you very much, Justin.
Man, it's always great talking to you. So thanks for having me on the show. All
right, we'll see you next time. Take care.
Yeah.
Guys, that was Justin Krebs of The Proactive Investor giving us some insights into, well, I guess we talked a lot of different stuff here. Now, for Gene, obviously your question there was pretty high level as far as, what considerations do I need to think about when I'm pulling this money out? Well, it's about mapping out all of those investments that you have. And I would literally take one of my favorite things to do. I know it sounds really stupid, but I have a 4 foot by 8 foot sheet of it's really thin plywood, like 1/8 inch thick, and I built a frame for it and have 2 little hooks, and I can hang it from the ceiling. And I'll hang it up there, and it's in the garage, and I'll put white pieces of paper on it, and it becomes this giant work board. So I have everything all in one spot, and it works, for all the different projects I like to work on. But let's take the retirement for instance. You can put up your accounts in different sections, and then you can say, okay, well, here's how much I have. And then you start to just build out this giant math equation. Of course, some people use an Excel spreadsheet for this, but I'll start with the big picture on a wall and say, here's everything I have, whether that's Social Security and 401ks and IRAs and investment accounts, and then ultimately figure out how each one of those will impact me for the time frame that I'm looking at, whether that's the next 2 years, next 10 years, next 20 years. And then we can say, okay, this one's going to be a potential problem for me in 3 years because I have to pull too much out. So how would that impact me if I did roll that over and go to something like rolled into a Roth backdoor IRA like he was talking about, so I can pay all the taxes now and then for the rest of my life? Where's that break-even point where if I'm growing those assets over time that I'll be saving money on taxes, even though I'm paying a lot up front to roll it? How long will it take for me to cost all that out? So that's how I would approach, reducing your tax exposure, is just putting all the variables in front of you and saying, okay, here's the things I can and cannot do, or is this going to cost me a lot more money if I do this, less if I do that? Great. Be surprised at how simple the minor changes impact. Like Justin was talking about, you can take out your Social Security when you're supposed to, or you can prolong that, and they'll give you 8% per year extra, which, you keep waiting a few years, and all of a sudden now you've got your money. It's going to last you a much, much longer time. Of course, I'm the ultimate skeptic, you guys. You know that for me, I just think that Social Security is a joke. It's not going to be there. If it ends up being there for me, that's even better. It'll be a nice little added bonus once I get to that point, but I pretty much assume it's going to be gone altogether. All right, yeah, so because Social Security is tied to inflation, there's an inflation adjustment on it. The inflation aspect of what we have right now is actually increasing the Social Security payments. All right, I think that would do it for that. So Gene, you got that one. I'm going to answer this one real quick question, then I want to wrap it up here. We've only got 10 minutes left. Oh, hey, great. Thanks for the spam. I'll block that user right there. Boom. Amazing how all of a sudden they try to spam you. This was from Jay Bess. He put this one down on the YouTube. Jay Bess says, do you use cash or margin for your accounts? I'm a fan of margin with never holding a debt. Build these surpluses for the ultimate rainy day. Personally, I do use margin, but I'm very cautious with it. Margin or leverage, synonymous words in my opinion, have been the biggest destroyer of people's accounts. And I've witnessed it hundreds of times where someone's over leveraged. They'll come in with a $10,000 position and then they use 100 to 1 leverage, and it just moves a couple of points and their entire portfolio is gone. So I will only really engage with heavy leverage when I'm in a big winning trade and things are rolling, and I call it snowballing into a position where it's just getting bigger and bigger. For the most part, the only real margin I'll be using is in the instruments themselves, meaning I'm using margin for futures. I'm using margin for my options trades. I don't use margin when I'm trading equities unless I'm in a short-term day trade where I'll be using that margin. But you get plenty of margin and leverage by using options and futures. And with Forex, it can be even more dangerous. As you guys know, in the U.S., it's 50 to 1 leverage for spot Forex. But you go internationally, you can get 500 to 1, maybe 1,000 to 1 leverage. It's great if you're on the right side of something, but that can just liquidate your account very quickly. So there you go, Jay. I do like leverage, but I hate telling people that I like leverage just because I don't want to encourage people to use it. If you can't make money with your own money, then don't expect to make money with borrowed money. And margin is borrowed money. So I would say start with just cash in your investments. Build till you get confident and understand what you're doing, and then you can start to get into leverage. But too many people start off, their first live trading day, they're in 10 to 1 leverage, and they get smoked, and their account's blown, and like, oh, it was the school that taught me bad. It's like, no, we didn't. You just went all in on a penny stock, you idiot. Anyway, sorry. Okay, let's talk about tomorrow. We've got BBY, Best Buy, not BBBY, which would be Bed Bath & Beyond, which is up another 25% today. Kind of ticked off because I sold the 1050 calls against my position, locked in some really great premium, and they took it away at 1050, and I think it hit like $13 today. Let me real quickly bring up BBBY here for the rest of us. There you go. There's your Best Buy. 24% pop today. Gotta love that. Right as I get liquidated at 1050 and had my shares taken away from me. Thank you very much. Market-wise, before I go into that overall announcement, I'll start at the bottom. Bitcoin took a dump today, down 2.23% right now. I actually bought some more Bitcoin and some more Ethereum last night, so I'm okay with that. NASDAQ, was doing fairly okay today and then just kind of gave it back near the end. I'll show you an intraday chart here. Here's your 5-minute of it. It was kind of just traversing, looked like it was building up in the second half of the session, then all of a sudden just fell apart that last hour of the trading session, but now moving up just a little bit here. So not the worst for NASDAQ, but down 1.01%. You had the Russell was down 0.87%, and here's your daily of that. S&P 500 was down 0.7, closing at 4030. I know a lot of people were talking about this 3900 hitting it today. Well, we didn't quite get there. I didn't think we'd fall that far, but it certainly is in play going forward. Dow futures, or Dow was down 0.58% to 32,075. Gold unchanged on the day, but almost everything has the same basic pattern. After that big shock we heard on Friday from Jerome Powell, you have bottoming and topping tails, and most of these markets opened and closed about the same place, all except for crude oil, which had a huge up day, 4.2% move to the upside. It ripped through overhead supply and is actually headed right towards the next one, which looks to be right around $98, and you see a couple studded little areas of supply going forward. But all in all, a pretty great day for crude oil. And of course, the dollar index, which broke through the highs today, but ultimately came back down, again, looking just the opposite of what our equity markets did. So here is your earnings calendar for tomorrow. Really nothing spectacular today, but you have Baidu, Best Buy, Bank of Montreal, Hewlett-Packard, and HP reporting tomorrow. And then this is the mother load. It is a huge serving of economic announcements tomorrow. As you go through this, you can see you get some decent ones for the British pound, but really the U.S. is where the eyeballs will be focused on tomorrow. Big expectations for a sharp decline of over 1% in the Case-Shiller Composite 20 Home Price Index. You can see consumer confidence and JOLTS job openings. Remember, we have 4 major job announcements happening this week, and then HPI data, so home price index expected to contract as well, which would indicate cooling off of the housing market. Oh, but we're not done. That's just the first page. I have 2 pages of announcements. It's crazy. Japan has retail sales tomorrow, and they're expecting a surge. Might have to do with their yen getting decimated and more people buying goods and services, but expecting a nice jump there in retail sales numbers. You can see manufacturing going on for China, but I don't really care because I don't trust that data. And then down at the bottom, you've got some preliminary GDP data coming out for France and also German import prices, which rounds out your economic announcement day. All right, I think that's going to just about do it for me. Again, we've got, and Joe, there's so many different things we could talk about. Like there's infinite topics today, but I wanted to get Justin on because I generally don't focus on that long-term picture, and it is critical. I think it's really important to news before and after the market session. After the market session approved. I think it's critical to think about your retirement. And luckily I was pushed by my boss when I worked for a financial planning firm. She's like, just start as soon as possible investing for the long haul. So I followed her advice, and very fortunately I did. But I think a lot of people don't. I think a lot of people are very underfunded. But also, it's not just how much you have in your retirement accounts, it's what you do with it, whether that's the Social Security, the different tax implications, using annuities and life insurance products. I think it's all very, very important. So thank you, Justin Krebs of The Proactive Investor. You guys can check out his website if you'd like to find out more information at theproactiveinvestor.com. For tomorrow, we do have another exciting show, as I always try to have exciting shows. We're going to have the bond master himself, Mr. Bill Addis, on the program. Lots to talk about, especially with the current interest rate announcements from Jerome Powell, as well as his statements at Jackson Hole. We'll have Bill Addis on tomorrow to talk about what on earth is going on, what his perspectives are. If you have something that you would like to talk about with Bill Addis, put it down below the YouTube video. You can just go to whatever YouTube video it is, type in your question there, and I will get them all queued up and ready for Bill Addis on the show tomorrow, starting at 2 p.m. Pacific Time, Eastern Standard. If you have any other questions, you can email me at TraderMerlin@gmail.com. Until then, happy trading, everybody. Hopefully I fixed the audio. I will find out right now as I output the show for the podcasters on iTunes and Spotify. Take care, everybody. I will see you tomorrow.